Hello, ladies and gentlemen, and welcome back. The most talked about trend line in the world has been reached again. And as many of you know out there, what happens here will have ramifications for stocks, commodities, and cryptos throughout the world. As we also can see, it could be the beginning of a new trend, a lightning bolt occurrence. And if this does occur, it would be the first time since 2021 that we've seen something like this. It really comes down to a lot of factors, but just leading into this week, we have earnings, we have trillions of dollars of options expirations, and on top of that, we know that what happens in January can lead to massive moves in the next 11 plus months. Well, welcome back everybody to the Daily Show. As you know, we've kicked off earnings season. We've got the data on that moving forward this week. But on top of this, I want to talk about money flow, macro data, lead indicators, and the key levels that you should be watching for the week ahead, along with those options levels. JP Morgan, Wells Fargo, Bank of America, and Citi, they all technically beat earnings expectations, which were pretty low, but they snapped almost negative 2 to 4% down on the day to end the day upwards of over 2%. That's a big move in financials. We've got some charts on that a little bit later on. But let's begin by discussing some things that we share over on our Twitter at FX Evolution. Make sure to follow it, links in the description. And this is money inflows. 2023 could be all about money inflows. Effectively, what do the big investors need to do to beat the index or beat what they're cited to have to beat to get their extra little payments at the end of the year? This is going to be a big story. Fear of missing out realistically now on the rally, if there is going to be a rally. And I think most pundits believe there's a rally sometime in 2023. Whether it's now or later on is still to be determined. So we know that smart money versus dumb money inflow has changed pretty drastically over the last couple of trade sessions. Dumb money thinks to be buying in pretty heavily. Basically, this is smaller money inflows have made a large move over the last 4 trading sessions. And we are actually now bullish for 4+ trading sessions, which is something else that we should discuss when we look at the S&P 500 later. Smart money, at the same time, hasn't really been purchasing at any faster rate. In fact, something else that we shared over on our Twitter, which we'll go down to, we'll show you that leveraged money and money inflows in general for managed money, which is the blue line here, haven't really spiked in recent weeks. They've remained consistent. Are big money managers still purchasing? Yes. Are they purchasing at a faster rate than they were during the dips last time? Absolutely. But realistically, we haven't seen a spike up since it's been in this massive trading range for the last 2 months. Leveraged money, on the other hand, has begun building a short position, something we'll need to watch over the next weeks, especially if we continue to rally through this well-known trend line right now. Let's move over to also another big stat that's coming out here, which is the New York Stock Exchange net high-low percentage. A lot of people are going to be talking about this being a new bull market rally, and there are a lot of stats to support the beginnings of that. And we've got those in today's video going well over almost 70 to 80 years of trading data and, of course, stock market data. Most net new highs in over a year. So this is actually the most bullish move, even though we're not at the most bullish level, since the beginning of all of this bear market. And that's fairly significant and definitely needs to make us think, well, should we be paying attention to that? Do we need to consider that this could be a new big rally that we don't want to miss out on? These are the problems with markets. You've got to weigh up the positives and the negatives and somehow come to a clear conclusion. Fear and greed indexes can help you with this. And of course, greed moved the ticker quite a lot on the Friday session. We went from being just in the beginning of greed to 63 in the greed. If you're not familiar with what happens here, it's basically made up of around 7 fear and greed indicators. And the main ones moving right now have to be stock price strength, breadth, and of course, put call options. And what that means is that basically less puts have been entered in the last couple of trading sessions than calls. We've got the big levels on that coming up in today's show. Very important that we follow and know where these big option levels will be. It's something that helped us to, of course, define where we are right now and the fact that this market would most likely rally off those 3,700, 3,800 levels. So we mentioned that January is super important. This is probably why. If we've ever seen a Santa Claus rally, which yes, we technically did get if you took the Santa Claus rally dates from the end of course, Christmas all the way to the start of the new year in the first couple of trade sessions, the first 5 days of data, which we know has a positive correlation over 80% of the time, and then the January return. When you've had a previous year that's been negative, it just doesn't miss. Now, could there be a violation of this? Of course, it's just stats, but I think January's return is going to be incredibly important to market pundits and really bring us into, okay, we need to consider that by the end of 2023, even if there is a crash or a secondary fall or anything like that, that there could be a positive year coming through. We've long suggested or thought that maybe we'll sell off sometime during that first or second quarter, and then by the end of the year having a turn. That would be the perfect scenario, I believe, just because it would give us a high VIX, give us a lot of correlation with some of these market switches that you expect, and it would be in line with certain things that have happened in the past. And really, we can only use part of the past, part of our knowledge of the history, and also the charts to make better informed decisions, which is what we try to do here on the channel. Speaking of making better informed decisions, might be worthwhile checking out entering into our free competition. All you have to do is put in your name, email address. We're drawing it in a little under 2 days here on the channel, and you go into the prize draw to win one of 4 prizes. If you win the first one, then I'll be talking to you very soon in February because, of course, that's our group mentoring. Good luck to each and every one of you. It's free to enter. It's just something to say. Thanks so much for supporting the channel and us giving back there a little bit. Breadth thrust buy signals for the New York Stock Exchange. We're going to go into the bullish case scenarios here. So we just saw that the New York Stock Exchange new highs was getting pretty serious. Now, last time we saw a reading like this was actually back in 2020. And you'll notice over there, we ended up into a massive bull rally. At the same time, actually, interestingly enough, smart money, dumb money, we saw dumb money inflows continue. And this is, of course, a historical rally that had a lot of retail traders all over it. In fact, a lot of smart money traders missed some of this run. So you could argue that sometimes dumb money does beat smart money, but historically it really doesn't. Let's move over now to the buy signal. So we just got a buy signal from this. Does that mean you jump out and you go, wow, it's time to get in? Well, here are the stats to what's happened next. And what you'll notice is percentage-wise, it's not too bad. In fact, it's mostly 70s and 80% over the next couple of months. This is one of the big readings that a lot of bulls are coming out with, and you can't really deny that it tends to lead to more bullish moves. You've also got breadth thrusts in the Nasdaq showing again that there's strength here. So there's not just the S&P 500 or New York Stock Exchange, it's also the Nasdaq coming through. These ones are actually a little bit better statistically. You've got 83, 96, 96. And the Nasdaq is still very beaten down. Remember, at the time of this recording, it's still over negative 30% plus from top to bottom. Now, when you get these readings, does it mean, oh, I'm going to go buy into the markets? It doesn't necessarily mean that, but it just shows you that you're at a critical level. And we have seen breadth, we have seen thrust signals fail previously in 2022. Not as strong as this one, though. And I think that's very important to note. These technically are the better breadth and thrust signals than we've seen in a while. And then brings one of the ones that I always talk about a lot here on the channel, which is consumer discretionary. Yes, technically it got a thrust signal in it for the first time in a while when you take into account all of these reasons. Again, 70s and even 80%, upwards of 90 in the next 12 months of bullish signals. It's not always correct, but it's interesting to see so many thrust and breadth signals coming through. Is this Wall Street knowing how the stats play out and how people will build a story? Traditionally in the past, this has been one of those better signals when you've had multiple different markets, and especially the bigger ones that have over 3,000 stocks in them saying, hey, you know what? We're looking at new thrust, new breadth signals. It's been usually hard for that to be false, but we're at a critical level. This is why we're saying the next 2 zones are going to make or break probably the bear case for 2023. And this is the interesting thing about markets, but also one of the toughest things. On the surface, if you look at the market, you would say, well, the market's generally worth about 17 PE forward ratio. That's where we are still at this time of recording pretty much right now. But on a cheap scale, especially if you're an investor, you really want to be looking at 15 or under. And if you can get 15 or under, you're usually sitting there smiley faced over the long term saying, okay, I've picked one of the better levels. I still think forward PE is going to be very interesting to watch this year. And I wouldn't lose hope of the bears taking control here. It's just we're looking at both cases, which is something we like to do on this channel. I am basically optimistic on markets over the next 3 to 4 years. And the main reason is because although everything's terrible and this will eventually become a big problem in the world, I do think China's re-stimulation of the economies, while it's going to cause some inflation issues, I think in the next couple of figures, we'll talk about that more if you follow this channel. Realistically, we have to believe they're going to hold it all together just with the glue and the sticky tape and everything everywhere, and then eventually it will crack. I just don't know if it's this time. Usually it's like more of that black swan, no one sees it, similar to what happened a few years ago. Let's now talk about the money flow, because we haven't just seen an interesting money flow into the markets, but we've seen a rotational shift. Clean energy, gold, metals, solar, semiconductors, communications, and consumer discretionary, they're the best. We've talked about this now for well over a week and a half, and guess what? They've had the better returns over that period. And this is so important. We went from being all about utilities, staples, and healthcare defensive sectors during December of 2022 to suddenly being all about consumer discretionary. And this started basically just after Christmas. We got that big switch starting to come through where these ones were the new winners. On the Friday session, this is what we had happening. Again, we didn't really see too many of the mid-tier kind of defensive sectors coming through as the strong ones. But if we see XLP, XLV, utilities, those start to make the best movements in the next couple of sessions, then we know, okay, that's Wall Street getting ready to potentially dump the market. They're certainly not doing that at this stage, and it still remains anything to do with inflation and really the China recovery story. That's some of the best sectors to be into. So very, very interesting there. We've got that inflation coming down. Realistically, that's pushing so many sectors: semis, consumer discretionary, technology, and small caps. As we enter into the back end of January, we not only have trillions of dollars of options expirations in these markets, but we have big earnings coming out. And as we know, we enter into a week where we've got the big ones: Goldman Sachs, Morgan Stanley coming out, and then we have the first of the tech stocks. Could this be a pivotal moment in markets? Thursday, this is going to be a big one. Netflix is coming out with its earnings. And then, of course, the week after, we have Tesla. And I think Tesla will be very, very interesting. These two kick off the technology side. We've seen the beginning of the banks, which I would say look mixed. They're not really like, wow, that's amazing. But they're certainly not like, whoa, this is terrifying right now. It could be that we have to wait till Q1 to really find out how much damage is being done in the economies, but worthwhile watching. Let's now jump into the charts, and this is a historic moment. The new low of the VIX since realistically 2022 all started with its horror show sell-offs. Yes, we've gone to the 18 handle. Now, a lot of people believe that this is an incredibly important time for the VIX. And that's because the VIX, or the volatility index, historically has been considered the fear and the greed index. That is, if it's high, everyone's fearful. If it's low, everyone's greedy. Because of options changes that have happened in the last, let's say, year, the VIX is becoming much, much harder to read in general. But we are down at a critical level. And I think many people bought VIX calls probably thinking there was going to be an increased amount of volatility leading into the inflation number, which is a fair assumption to make because it has been every other time. And then suddenly this time around, it was directly on the level. Funny how that happens. And it would have crushed them in terms of implied volatility and all the Greeks really coming in. So the VIX sits here at 18, a critical level for the S&P 500. And if you overlay something like that chart, it shows you really how important it is to see it. Because if you look at this, you'll notice that when we've hit previous peaks, we've been very low on the VIX. And when we've hit, of course, previous lows, we've been very high on the VIX. So it's still the fear and greed index for now. This is pivotal. 18 handle, very important level. The next kind of 2 or 3 points of the VIX could be very, very interesting indeed. Let's move over to the financial side of things. As we mentioned, financials came in what looked like soft. Then they kind of took the level. They basically ended up at this strong resistance. Let's take a look at this on a weekly chart just to put it in perspective. Because if financials do lead by too much, it's hard to drop the market. And what we mean by that is usually financials take the brunt of a very painful market. Notice we have that kind of trough, peak, higher trough, potentially higher peak situation. I think what happens in the next 1 to 2 trading sessions this week coming is going to be very important. And do remember, we open on Tuesday this week. So it's only a 4-day trading week with trillions of dollars of options expiration happening on that Friday session. So it's going to be a very, very important level here. And depending on the candle formation, what if we get a wick here? We might know a lot more about the next moves in the market. And that's what you're really doing a lot of the time with trading. You want to have patience to react to the market, showing you that it's made a false break or it's made a true break, so that you can then take advantage with a lot more statistics on your side than just anybody just throwing money in the markets on a gut feel. That's not really the way we want to do it here on the channel. US 10-year, this was interesting, a spike up, possibly because of the earnings. Maybe it's a little bit hotter than the market. Even though it looks good for the companies, maybe it requires a little bit more work to be done. If we look at the 2-year, you can see the spike here back up. And what's more interesting is when we go to the September of 2023, after the drop off the inflation number, we suddenly spiked again. Maybe it's going to be important for us to watch yields over the next couple of sessions to see, as the earnings come out, do we see yield expectations rise, as it turns out that the Federal Reserve will have to go maybe a little bit higher on interest rates to cool the economy. Because remember, they still need to cool the economy and stop this inflation story. And then maybe you need to hold it for longer. We did see I think a significant shift off that one earnings result. Let's see what happens when we get a few more. Dollar index, this was very, very telling. The US dollar trade of 2022, the best one, as we suspected, has not been for 2023, and certainly not the back end either of 22. This is a very nasty candle. I'm going to set an alert above it just in case it ever does get taken out and I forget about it. This is something I like to do a lot. You set alerts for key levels that you know that if you do get that, and you usually want to note it as well, it's a significant shift. You're going to forget about this chart if you're not trading it. So you want to set some of these key levels. Now, where do we find ourselves? We just showed up as one of a very bearish looking signal. So you'd have to think that dollar is going to be mostly met with sell demand in the future. But we do also find ourselves at an incredibly good level of demand. I mean, this is a significant level of demand. We've seen it before, big support. A lot of you guys will see it on the charts. And it's going to be very interesting to see how the market reacts here. If we go down to the 15-minute chart, the Friday was interesting in itself. So we basically saw market go lower, higher, lower, low, higher, high, and then switch back and then find some buyers. I think it's at that point where if buyers are going to recommit, they'll try recommitting pretty much right now. And it's just, this is a very small time frame thing, but we did see a small shift here, which could show us the beginning of a very small time frame accumulation. Remember, it has been heavy selling now on realistically the DXY for quite some time. And if you take this into account, the only other way of really looking at it is we get that move there, and then we're basically looking for that move again down to the 152. It is bearish, don't get me wrong, but that was a very interesting move that happened on the Friday session. And we're at 4K, remember, for the S&P 500. So could we be seeing a little bit of dollar buying and then a little bit of selling off the 4K level? I think you probably will want that correlation to occur should it would be happening. This is the first little inkling that maybe some buyers are there. Although it may not look like it, that is fairly important. Let's have a quick look at a 2-hour chart as well, just to see if we can see anything. Not really from here. I would have preferred this type of candle would hold. So basically it would go down, find buyers, move back up, close somewhere like here. That would have been a much better style trade to lead off probably the Monday futures that come in, but realistically the Tuesday session. Let's move over to gold now, and it continues to be an absolute monster. I shared a chart on this, I believe, a little while ago, but basically gold and yield is really important to think about. Part of the reason gold's running is because there's an expectation on the forward yield that there's cuts through 2024 basically to 25 from the Federal Reserve and central banks around the world. That's making gold very strong. There's other reasons, of course, as well, but this is one of the lead reasons. And it's not going up because inflation. It's most likely going up on the stagflation story or the cut story. Very strong. Currently, everyone is spreading the idea. We've been talking about gold being strong all the way down since here. We liked it as the asset of choice. It does tend to have an incredible Januaries on it, gold, so it's running that way this year. But yeah, I think you're starting to see people probably now calling 3K, which I think is very possible at some point in the next couple of years, but they're calling it pretty quickly. And I'm waiting for people to start calling the big 10K. Once that starts to happen, you get those 5K calls and 10K calls, watch out for gold to be going on what we call parabolic moves. And then I want to see a parabolic move into a crash, rally, and then that'll be the end for that current move. We will follow this story. At the moment, I got no reason to say it's negative or bearish. 1920 breaks, very significant. Could be going towards 2,000 an ounce here. At this stage, very, very strong, but definitely disconnecting from reality. Put a 220 moving average on the chart, you'll see what I mean. Now, oil was a really, really tough trade in the last week. 77 was, of course, a level we liked. It came up before sold off, which gave us a lot of pause here. I set the alert for it. Under 77 should have broken low. It didn't do so, and it's moving up. I actually think oil could do pretty well here. And yes, I've been pretty negative on oil. I've been negative on oil since 120. We have together. And I'm just wondering whether we need to start switching our trend here. Of course, I wanted 65 a barrel, 66 a barrel. That's certainly what I wanted. But with China reopening, with the demand probably going up due to that and a few other things, we've got to consider it. Plus, we know that we've had that kind of potential basing scenario. We've got a key level coming up here, that 82, 81.50 a barrel. We've had a lot of wick rejections in the past. We're leading into that. I'm just wondering, and I wonder what you guys think in the comments down below, whether oil is actually going to rally into those 90 pluses again. I feel like it could do so. And this is the type of charting that we need to be considering here. There's the weekly. Let's take a look at the monthly as well. Maybe that 65 won't happen. And this is part of the reason I say that. This month is going to be very important for oil. We've got one rejection, a huge rejection that happened, and at the moment, another one. That shows us demand buying. So it's a very important chart for oil here. Got to be super careful, especially on the short side, that the risk is not as good for the shorts than it is for the buys. So basically, it's not really worth it as much to short like it was at 120, 110, 90 a barrel. And the buyers, I could see them recommitting here. Let's move over to Tesla. It continues to hover within a zone. Looks like if it does break out this week, options, I guess high expectations are just underneath that 130, which will be a big key level. And I think a lot of this has to do with whether the S&P 500 moves out. The S&P 500 breaks 4K, closes above, you'd have to think Tesla's moving to that kind of 130 a stock, and that will be a key level. For buyers, you're looking for the market to come back down to that 115 and then seeing how it reacts around here. And if we do this, where we come back to the 115, then gap low, I think there could be some serious shorting coming on. That's not going to happen on the Tuesday, so we'll come back to it. But Tesla, one to watch. Options-wise, if we look forward to the 20th, we know where the max pain is, which is 135. So that's actually quite a lot higher. As we said, 130, that should compress in. We know the 100 puts, they're suckers. Unfortunately, they're going to lose all their trades. We said that a few weeks ago. We were very comfortable with that. And we don't have any clear strike zones, but you can see that these probably will shift quite a lot through the week. And we'd expect that 130, 125 scenario to start to become bigger with the calls. So watch the max pain this week. It's the third week options expiration. It's going to be important for Tesla. Let's move over to Apple. It's hard to hate this chart. It really is. I'm just telling you, I can't hate the chart. It looks pretty good. I mean, we said that recently that we like these charts because of these bullish wicks. It was the same thing with Amazon. It was the same thing with Nvidia. They all had those buyer kind of looks on them. And this is the tough thing with this 4K level. I've got to say, these bullish hammers and rejections, they all show signs of wanting to go to some interesting gap fills. So on the buy side this week, if Apple can move through and some other stocks end up going through, and that pushes, of course, the S&P 500 through 4K, I think there's real scenarios where we go towards things like 143 on Apple over the next week or two. We'll talk about that more later. There's not much to hate about this chart right now. For the bears, you're looking for breaks underneath, break and closes probably underneath that like 131 area. That to then solidify maybe a short-term high and looking towards that short. We haven't seen that yet. We haven't actually seen a sign of bearishness yet. More on the S&P 500. There's the expected weekly high and low levels. Amazon was flying for the week. I'm not actually sure, but let's just go to the gap here. I think the percentage, 13+%. Amazon is a consumer discretionary. It fell down to close to those 2020 levels, which was one of our key zones. I love this level. I looked for it for a long time. I love this level too. I've got alerts underneath it just in case, which is that 60 kind of 7 zone. But this is significant. So people that are feeling FOMO, I think you've got to put it in perspective. Is Amazon still, relatively speaking, a decent price? It's not bad. Do we like the daily? It's tough because if you put in things like trend lines and stuff, you would notice that a lot of these things did break through. So you got little breakthroughs of trend lines and retests. You've got that big bullish wick. I'm not sure if I like really anything to do with Amazon here, because it's such an aggressive move, but you can see the basing, you can see the snap of some of these highs. There's a significant level probably coming up around that 106 kind of to 105 zone. So we'll be watching that. XLY versus XLP, this first ticked us off to realistically a huge rotational shift. Since that, we've put in 4 big days of basically growth versus defensives being super powerful. It's a great one to have on your charts, a significant shift. And if we look at a weekly, that's what it looks like. I just want to put this into a monthly for a second here. So we'll go over to a monthly. Again, very significant shift. You'll see that if this continues to do well, it often does mark the beginning of new bull rallies. We're not there yet, but certainly looking at it on the charts. Let's move over to the US 2000. This is the Russell. Of course, we've got a significant high here sitting around 1880. Beautiful triple wick rejection bottom. We did talk about this one, and it just kept rallying and rallying and rallying. No bear turnarounds. We're coming into a critical point, interestingly, that will probably get hit during the Tuesday session. What a zone. Many closures here, weeklies, dailies, all sorts of top-end highs, and I think a very significant level. You can see it here on the daily that's about to be reached. Last time we saw a strong reaction from this zone. Again, we'll be looking for what can we get. If it snaps it, we've got to think that market pullbacks at that point will be met by buy demand. And I feel like we go towards that 2000 after that point. This should correlate with the S&P 500 levels that we do have on the charts. ARK, just showing you again, it's all about hyper growth at the moment. They've been the best stocks of the last couple of weeks. Short squeezes did incredibly well as well. Shared that chart over on our Twitter. Basically, they were returning like 16% over, I think, the most shorted stocks in the market across the board were all squeezing. These are things that we do see in signs of everyone getting convinced that the market is going into a new bull market rally. The thrust and breadth indicators, I find it hard to ignore those. I always do, because they are significant. I think as investors, that's why we're saying that possibly big money, if things do break, they may have to jump in to say, well, we can't miss out on being too far behind the benchmarks that we're leveraged in on. Of course, balanced benchmark would be the big one, 60-40 splits there. US 100, there's the golden pocket coming up. Again, if we put in some interesting levels on the Tuesday session, could be possible to get up to there. Price-wise, that's coming in at around that 11,642, but we are at critical zones. So because we now know what happened on the Friday session, I'm going to put an alert here for the bears at 11.3. And that's because if the market, which has now made a higher high, ends up busting that low, it's probably going to do something like this. And if that occurs, well, the bears have taken more control of this market. Let's move over to the SPY. Options highs and lows for the week. Again, look at these charts. Interesting stuff going on here. We've basically filled that all-time gap that we wish to, and we're at a critical level. Let's move over to how critical this zone is. Trend line down, as we mentioned at the beginning. Huge level there. Let's go to the daily. Daily 200 SMA. Yeah, technically it broke above it, but we've seen that before. absolute critical zone. This is one of those times where I think a lot of people are talking about this level. I've seen so many mentions of the 200. It's almost like, as they said back in the day, they used to say if the taxi driver or the person I think it was like the elevator was talking about something, it's probably not going to work. I don't know, but you guys might be able to let me know in the comments down below. I think everyone's talking about this zone. I like it when we spot something as a community first. We're seeing it, less people are seeing it, it's more likely to occur. So yeah, critical zone, 61.8 fib pullback, 200 days SMA, downward trend line, fill of the gap, 4,000 psychological. You would think at least one bad red day out of this. And one of the reasons is because we've had 1, 2, 3, 4 green days. Now, that may not seem rare, but 4 green days is interesting. There's 4 over here, and there's 4 over here, and there's 3 over here. Actually, it's kind of rare to get 4 green days in a row. So I think 4 green days is a big one. Pushing into at least the Tuesday, you would hope being a red day, not a green day. If we do break through these levels, though, these are I think these are the zones to watch. 41.13, and then I believe it's actually 42.83 after that. So I've shown the unfilled gaps, but I think this 41.13 high, that would be a perfect level to take and then potentially short, and then 42.83. And this one, I'm going to stack it up if needed, if we break this trend line in the future, because that is going to be super critical, super critical. If we do fail here, I believe 39.20 is going to be a big zone. And then of course, 37 into those 37.40s, 50s. And we still have that little lonely unfilled gap down there at 35, 82, 80 zone. Very important. Here's some of the key kind of monthly, weekly zones I've just primed out. And again, you'll notice how many of them stick around the tops of these markets. Very critical. We'll check out what happens there. We'll bring it back if necessary. Big rejection weeks. Let's look at the Friday session now in the smaller time frames. What do we have right now? Well, we have a high. We obviously have lows here, and we have a higher high. Oh, it's so significant. Bears, you watch. You are wanting that 39.20 to be hit. If it gets hit, then you make a new low underneath these, take out those stop losses that are there, probably trigger a bit of a buy, and then move towards the short. This is super significant level. I really want to see that type of thing happen. If you're a bull, you just want another bullish day. You don't want the markets underneath realistically this level here, probably around 39.40, and then you're hoping it just keeps rallying up, hits that 41 plus 100 gap fill, and then we move maybe to buying and possibly even buying to that 4,300 just underneath. So we'll move ahead if that happens. At the moment, we are at the bear market zone, and we know where the bear market guys potentially take some shorter time frame control, and that is getting underneath that Friday and Thursday session. Probably a lot of orders sitting underneath that. We need to see if we can trigger them. Let's have a look now at the options expirations for the week. It's not pretty. All the puts, as we mentioned here, for literally a month, they're all getting destroyed. We expected this. That was very lucky we expected this. Hopefully most of you adhered to this kind of reasoning. You can't be short into so many puts. It's a Christmas tree that was put in before Christmas by retail traders, Wall Street players, everybody. 5.1 million options expiring. Super critical level. 390s here. You can see the zone. You can see how many puts are now on the 390s. You can also see the calls starting to appear. Follow us this week. We'll be seeing how this moves. I would expect the calls to hopefully spike up, but that 390's got me annoyed because basically what that's telling you is that even if the market takes control with the bears, it won't want to go under 390 for too long. So it might go like that 39.20, rally up, and then end potentially even on the 390 at the end of the week. Just an interesting concept. Notice where Max Payne is as well. I just noticed that. So that's kind of the analysis here. This is a very real scenario. We'll find out, but very real there. Crypto traders, you're probably rejoicing. How good is that? Mass moves here and probably a bit too fast to rally, but look, nothing stopped it. There was nothing stopped. I actually thought somewhere in here we might find a little bit of selling. This is why you follow the price action. There was just nothing in there. Like you look at the 2 hour, it kind of just stopped at this trend line, sat for a little while, didn't do any switch towards the downside, and just went boom, straight back out. Big hit of the level. We did say 21,000 after this zone, and it smashed into it. So yes, does this really change our opinion on suddenly crypto becoming the best thing ever and it's all over in terms of bear market sell-offs? Well, you'll find most crypto guys will say this is the exact same top to bottom in terms of timings as the last bear. Now we go into 1,000 days up. I still would like to see that kind of 11K, 9.5. You might not get it. I mean, obviously it relies on the market actually going bearish, but let's put things in perspective. There's most likely at least one more pullback through. Key level here is 18,000. I think that's one to watch. We'll follow the crypto story as we see it play out, probably through the Tuesday session the most up here. We also know Ethereum hit that zone, that's 1,600, so well done to Ethereum players, and it instantly rejected off those daily close levels. So I'm actually looking for crypto to have a little bit of a fall now after what was a very aggressive move that everyone's most likely piling in on right now. You can just imagine how many people are like, it's back on, and sharing those prices. Maybe they're in the elevator already talking about it. We got to be careful if that happens. But look, it's early days. It's great levels. They've hit some of those targets, and these are fairly real critical targets here. For the week ahead, we've got through a lot so far today together. Let's have a look at the Wednesday. We've got core PPI, core retail sales, PPI, 8:30 a.m. We also have the earnings, of course, around that time. But it's not really about news this week. It is about earnings in the US. What do the numbers tell us? We'll be following that story. This is a massive show. If you're stuck with us, make sure to give it a thumbs up to let me know that you guys are the absolute OGs of this channel and you're loving it. And of course, subscribe, smash that like button. And remember, our giveaway, it ends in literally less than 24 hours. So make sure to put your numbers in. All you got to do is put in your name, put in your email address, and you go in the prize to win. Thanks so much for following us. We'll see you very soon. Bye for now.